Hi, I'm Todd Rosenbluth, Head of Research at VettaFi, and thanks for joining us for our latest episode of ETF360. We're here to talk about Fidelity's Enhanced ETFs with Mike Hagopian of Fidelity. Mike, thanks for joining me.
Thanks for having me, Todd. Great to be here.
Well, it's my pleasure. So Fidelity has just launched these Enhanced ETFs. Tell us about them.
Yeah, so just for starters, I'm part of an investment team at Fidelity, Todd. We're responsible for the management of a suite of Fidelity Enhanced ETFs. It's something our team has had a lot of experience managing these types of strategies dating back to 2007. And we're excited to be able to offer these now in an ETF format. The equity strategies that we're putting into the ETF space, they're designed to give investors core equity exposure. So think of that as having very similar characteristics to an S&P 500 or a Russell 2000 index, but also incorporating active management and doing that within a disciplined, risk-managed investment process. So we've built a suite of these solutions across various benchmarks, 6 in total. Couple I'll mention here now, the equivalent to our ETF that we're managing against the S&P 500 index, our Enhanced Large Cap Core ETF, that's ticker FELC. And then the equivalent to our Russell 2000 managed ETF, that's our Enhanced Small Cap ETF, FESM. The recently launched ETFs, they're conversions from existing mutual funds. So same investment process, team, objectives, ported over from the mutual fund. The added benefit of the ETFs, in addition to providing that active core equity exposure, the strategies are now available as a low-cost solution and have the added tax efficiency that comes with this wrapper. The process itself, we're applying consistently across the suite. It's really a marriage of incorporating our alpha insight, our team's alpha insight, scientifically applied alongside engineering portfolios to objectively incorporate the team's long-term views of what drives equity outperformance and doing that in a well-constructed portfolio. So maybe to boil that down or simplifying, this is a systematic process that we've developed. The drivers of those equity returns, those are commonly referred to in the marketplace as factors.
So that makes me wonder, how is this different than a multi-factor index-based product that many other providers have?
Yeah, I point to 3 main areas that are important features of our enhanced ETFs. The factors we utilize, the way that we're weighting those factors, and the risk management and portfolio construction framework that we've developed. So first on the factors used, the alpha insights are drawing from research our team conducts utilizing a variety of data sources studied over multiple market environments. The return drivers, they're grounded in economic rationale. Some of these drivers are fundamental: valuation, quality, growth. We're using these types of characteristics, but it's based off of our proprietary view. So this might entail using different ways to define the factors we're using or the data we're incorporating. So for instance, for a growth type factor, yes, we are looking at historical and forward-looking earnings growth as potential measures of growth. But we're also incorporating other insights such as research and development a company might be deploying, or intellectual property or capital that they have, and being able to compare that versus peers and understanding, is that growth advantage sustainable? We're also incorporating non-traditional factors. So data sources not found on financial statements, data from the options market as one example to complement some of the fundamentals that we're looking at. The way that we build our process signals, we think are differentiated. We're using, in some instances, machine learning or artificial intelligence, also bringing in broader insights as well. So not only incorporating stock level views, but also incorporating views on an industry that stock belongs to, incorporating our final view of that security. I think at the end of the day, we're incorporating more factors, more differentiated factors. Same concept as why we diversify across asset classes. Having more diversified return drivers give our portfolios, in our opinion, a greater opportunity to outperform over many different types of market environments. The second thing I mentioned, how we weight the factors, it's not just simply equal weighting, but looking over a long-term perspective of those drivers, return drivers, those characteristics. What's the return look like? What's the risk associated with that return? How is that driver correlated to other things that we're using? Creating an objective process, weighting those different measures to basically reward those characteristics or factors that have stronger risk-adjusted returns that are diversifiers. Those are going to have a higher weight in our overall modeling of securities, and that in our team's research shows that drives better outcomes. And then finally, the risk management portfolio construction. The team's developed a proprietary risk model that creates greater precision for managing benchmark relative risk. So the key in that is we're not going to drift too far from the benchmark. We're going to maintain that core exposure that I mentioned up front, one of the key objectives of these strategies. We're also employing additional guardrails, discipline in terms of controlling our sector, industry, country, region exposure. And then finally, this isn't a black box. So our investment team is monitoring these portfolios daily. And so there are risks that aren't going to be neatly modeled. And so we need to be cognizant of those in developing market situations and potentially add additional guardrails where it's warranted. And that's part of the team's monitoring of this. I think the risk management, I sort of equate to our portfolio being in a boxing match, but we get to keep our headgear on. So there's times we're going to take a punch. We're not going to outperform over every single market environment, but we're not going to get knocked out. And I think that's important because we don't want these portfolios to be a significant area of benchmark relative risk when we think about, an advisor and their overall asset allocation framework.
Yeah, that fits into my final question about how people can use this within a broader portfolio.
Yeah, so we want advisors to have confidence that the characteristics of our enhanced ETFs, they're not going to change through time. So the ETFs won't be growth one day, value another day. To me, this potentially simplifies their ability or their equity allocation framework, provides a cleaner implementation, and allows them confidence in using this as part of a core satellite approach. So satellite approach, they can express a tilt or a view. Perhaps that's a tactical view on value, maybe deploying a value-focused ETF with us, or a technology tilt using a sector ETF paired with our strategy. They can be confident, taking that technology example, that the technology exposure in our enhanced ETF is going to be similar to the benchmark. So it's not going to be 2x the benchmark and a theme that may already be expressed in the portfolio or within their overall asset allocation framework that they need to account for. Setting that asset allocation aside, my team, we've seen several other use cases. The ETFs can be substitutes for index solutions, right? These are still going to be low-cost solutions, but actively managed. So investors that are looking to get a bit more of a return out of their equity allocation, this could be a potential fit or solution there. And then the other, sort of use case that we've seen is being able to lower risk as far as active strategy goes. So these are low risk compared to some other, we'll call them really concentrated focus strategies. So if an advisor is looking to limit big swings in their portfolio and their overall portfolio risk, this could be a nice solution to either complement or substitute that type of approach while still maintaining that active profile. I think importantly, based on our process, the things that we're looking at for securities, the excess return profile that we're delivering tends to be in our team's research uncorrelated with other excess return profiles out there. So putting that side by side with some other actively managed strategies, we think overall would create a better risk-adjusted return outcome for the overall allocation as well.
Makes sense. And I know these are, as you mentioned, these are mutual funds that are converting into ETFs. So where can folks learn more about these products and the overall strategy?
Yeah, so a couple different ways to access these. The first on our website, i.fidelity.com. You can learn broadly about Fidelity's capabilities, but if you search specifically for Fidelity ETFs, you'll be able to find these there. And then the other way that advisors can connect with us is through a Fidelity representative. We've got an 800 number, 1-800-217-7926 to reach us that way as well.
Thanks for sharing about these mutual funds that recently converted to ETFs and for joining me on ETF360.
Todd, pleasure being here. Thanks for having me.
Have a great day.
Thank you. You too.